Wednesday, the 1st of August, 2012, the New York Stock Exchange opens at 9:30 in the morning. Inside Knight Capital, one computer begins buying and selling stocks by itself. It does not stop when each customer order is filled. In 45 minutes, it will execute more than 397 million shares and lose the company over $460 million. The trigger was not a hacker, a market crash, or a new trading strategy. It was a deploy that reached 7 servers out of 8. One missed server woke up dead code from 2003. This is how 45 minutes nearly killed one of America's largest trading firms. Knight Capital connected ordinary customer orders to the stock market through a high-speed router called SMARS. A customer sent one parent order. SMARS split it into smaller child orders and routed those children to exchanges until the parent was filled. Knight handled about 10% of all trading in listed American stocks. This router alone handled at least 1%. Buried inside SMARS was an old function called PowerPeg. Knight stopped using it in 2003, but the code remained on production servers, still callable. In 2005, engineers moved the counter that told PowerPeg when a parent order was complete. They never retested the abandoned function. If PowerPeg ever ran again, it could keep sending child orders after the parent had already been filled. 9 years later, the New York Stock Exchange prepared a new retail liquidity program. Knight wrote new code for it and reused the same software flag that had once activated PowerPeg. The plan was simple: remove the old code, copy the new code onto all 8 SMARS servers, and let the flag activate the new feature. Beginning on July 27, one technician deployed the change server by server. There was no written procedure and no second technician checking the work. Server 8 was missed. 7 machines received the new program, 1 kept PowerPeg. At 8:01 on the morning of launch, the missed server began generating error messages. PowerPeg disabled, each message said. 97 of them arrived before the market opened. They were real-time evidence of the failed deployment, but Knight had not designed them as alerts, and personnel generally did not review them. The last clean chance to stop the incident passed unnoticed. At 9:30, customer orders arrived with the reused flag switched on. On 7 servers, the new code processed them correctly. On server 8, the same flag activated PowerPeg. The obsolete function began sending child orders in rapid sequence, without regard for how many shares had already executed. One part of Knight's system knew the parent orders were complete. That information never reached SMARS. Only 212 parent orders entered the defective path. They became millions of child orders, 4 million executions, 154 stocks, and more than 397 million shares. Knight accumulated a $3.5 billion long position and a $3.15 billion short position. In 37 stocks, Knight produced more than half the trading volume while prices moved by more than 10%. A machine was creating a multi-billion-dollar portfolio. Nothing automatically disconnected it. Knight had no sufficient control comparing orders leaving SMARS with orders entering it, and no procedure to halt the router when its own output became abnormal. A position monitor showed the exposure only after trades executed. It relied entirely on humans, had no automatic alerts, and became inaccurate under heavy load. One account had a $2 million limit, but that limit was not connected to any control capable of stopping new orders. Engineers tried to diagnose the failure while the router stayed connected to the market. Then they removed the new code from the 7 healthy servers. That did not restore the system. It exposed PowerPeg on those machines too, allowing more incoming orders to activate the same dead code. The attempted fix made the incident worse. After approximately 45 minutes, Knight finally stopped sending the orders. It was left long 80 stocks by roughly $3.5 billion and short 74 stocks by roughly $3.15 billion. Unwinding those unwanted positions cost Knight more than $460 million. The commonly repeated figure is $440 million. The Securities and Exchange Commission's final order says over $460 million. The missed server was only the trigger. The failure required every defense behind it to be absent or disconnected. No deployment verification, dead production code, no alert on 97 warnings, no output sanity check, no automated capital threshold, no incident procedure that said disconnect first. The SEC put the simplest prevention in one sentence. A written procedure requiring a simple double check could have identified the missed server and averted the event. But the deeper lesson is that no deploy should be able to turn one forgotten machine into an unlimited financial position. Knight survived the day only after outside investors provided emergency financing. Its independence did not. Small causes become catastrophic when the system has no boundary between wrong output and irreversible action. This is Postmortem, one failure per episode rebuilt from the primary sources. Primary source, Securities and Exchange Commission Release Number 34, 70694, issued October 16, 2013.